Okay, in this video, I'm going to discuss the IRR, and I'm going to do this in the context of my book, if I can get down to the pages. And I titled, now I'm going to tell you, and maybe I put some stuff up here, and maybe I'm wrong about something. And for many years, for very many years, I have made an effort. I have tried to come up with an alternative to the IRR that is not the net present value, because I'll go through the net present value. That gets you nowhere. You have to make an estimate of the cost of capital. It's horrible. Now, when we think about finance, we often think in terms of risk premiums. We think of the equity market risk premium in the capital asset pricing model that I go crazy about criticizing. We think about risk premiums or credit spreads on debt. Now, we think about perhaps, I was going to say if you buy a stock, maybe how much money do you make if you look at your historic performance. You can compare your performance to a risk-free rate. Now, once we go forward, the question is, why can't we compute a risk premium instead of the IRR? Why can't we compute the earned risk premium? And another question will be, all right, if we do this, number one, does it make sense from a philosophical standpoint? And number two, does it even matter? In other words, if you have an IRR of 10% and the risk-free rate is 3%, then you've made a 7% risk premium. Can you say that? And so when I've worked on this book and when I've really start to think about this, the answer is absolutely no. The answer is that you can have a real alternative to the IRR that I argue is better. Now, I titled this, I might have to change my title, but I'm going to leave it. The IRR is not perfect, but it's not BS. I maybe shouldn't say, because Mr. Dr. Pupu of Oxford said the IRR is bullshit when he was at the Amsterdam Institute of Finance. That doesn't like me anymore, so I have to mention that. Okay, I remember I had a friend named Dennis who said, all I want to do is get the cost of capital out of all these metrics. And when this Dr. was criticizing the IRR, I've already been through this. I talked about this Justin Bieber songs, and when we value this, the problem with NPV, of course, is you have a difference in the NPV, and if the cost of capital is high, we never would do it. If it's low, we would do it. It's all driven by a cost of capital, which is then driven by all our unknowns. The risk premium method, that will depend not on some arbitrary cost of capital. It'll depend on the risk-free rate itself. Okay, so we go through this and then we demonstrate that the IRR, I hope the IRR is the growth rate. It's the growth rate in cash flow, but, so if we compute, we have a couple of cash flows here, I suppose negative 1,000, 400, 400, 400. The IRR is 9.7. Well, here's what you could do. You take this 9.7 itself and make that a reinvestment, and you take the amount of dividends you get, you put it in a bank account, and then this 400 earns 9.7, and then you get another 400, so you accumulate to this. then you start here. This gives you at 9.7 this rate of return. You add 400 and you get this total. You take this divided by this, raise it to the power of 1/3, and you get a compound growth rate of 9.7. So the IRR is the growth rate in your money, assuming you can reinvest it. Now, if you criticize the IRR, the problems with the IRR all come about because of the reinvestment rate. Now, the benefit of the IRR is if we think of an investment, we can think of different growth rates, different lifetimes of cash flow, kind of different levels of cash flow, but we've got that maybe with the growth rate. So here, if we look at a different life and make a little data table and look at it, who cares about the cost of capital right now, we can just kind of look around and see what kind of growth rate do we get in our cash flow. And if we have different growth rate in our investment, in our money, and if we have a different lifetime and a different growth rate, we get different answers, and we can do sensitivities and get the IRR. And there's no cost of capital to worry about. There's no big swing if we go from one cost of capital to another. And, this doesn't really tell us. This gives us, for me, much better way of thinking about an investment. Now, the problem with the IRR, I've already gone through some of this, I'm sorry to be repetitive, is that one of the big problems for long-lived investments, if the IRR is a little bit high, basically you're discounting the cash flows at a high rate. And future cash flows have a lot less value than current cash flows because you're using the IRR itself in the discounting process. Okay, so that's the problem. Now, here's what I have done. McKinsey at one time said, let's look at MIR, modified IRR. Oh, it's so cool because then we can put our discount rate in directly. And what happens is when you put a discount rate in 6%, you get an IRR that's basically equal to the discount rate if you have intermediate cash flows. Or you can look at the multiple of invested capital, and you could do it in fancier ways and say, okay, how much money do we get out compared to how much money we put in? You used to divide it out and get a payback period. Now you say, oh, no, we got to call that multiple of invested capital and do it over different periods. It's just a payback period. And then I struggled and I made a shit video on let's compute the return on invested capital with straight line depreciation over a period, and then let's weight that investment base by the cost of capital, and then we can demonstrate, we can have a way to say, well, in the future that if you discount that return on invested capital and do a weighted average, you can get a measure. You can get a measure of returns. It's all crap. God, I was looking for it, and then I said, okay. Then I was messing around with this risk premium method, and I thought, this is just going to be a waste of time. Do I even bother with it? Let's just say IRR is okay. At least we don't have the discount rate. At least we can do sensitivities and understand what our growth rate in our investment is. Kind of like the investment in a stock where you reinvest the dividends. Isn't all that better? And I kept on going, and now I'm gonna suggest that it's really good. I really believe it's good. And I've got to do a little bit of mechanics here too. So now what I'm going to do is move into a spreadsheet, and I'm going to put this spreadsheet on the website. And if I go babbling on a little more, okay, I've only gone 9 minutes so far. It's not so bad. It's going to be okay. Now, here, how about I'll go through this quickly, okay? I got to start with some philosophy. Pretend, and this struggles. I thought, let's. Taleb had a Russian roulette game. That's a little. I don't like thinking about that. Or we could say, let's flip a coin. I'm going to say, let's roll a dice. And now, I make an example from rolling the dice, and this is thinking about what risk premiums really are. And I said, okay, we could, if the dice is 1 to 6, I think they have 6 numbers, we're going to pay you 1,000 if it's 1, 2,000 if it's 2, and all that. And we can either give you a flat 3,500, that's kind of the average, and we can play this game today. You get 3,500, and how much would you pay to get 3,500? Okay, you'd pay that amount. Or you can take a risk. And there's volatility associated with this. And even though your expected value is 3,500, because you've got a chance of getting low values and you are risk averse, you need 10%. This number times 10%. You need a 10% risk premium if you're going to, instead of getting a flat amount, get paid according to the roll of the dice. Okay? Just so you understand. 2 scenarios, one flat, one risky. Okay? Risk premium. I think this is crap because a lot of people would say, I don't need a risk premium. I like volatility. I like risk. I like, life that's not so boring. But okay, we're not talking about this. We're talking about, maybe if it's a flat salary versus a salary and a bonus, whatever. You have some risk. Now, okay, that's the first. So we've got a risk premium. We just made it up. We're not saying it's good or anything else. And now let's move to a case where we could either play this exact same game 1 year from now or 10 years from now. If we play it 1 year from now, and we're saying, well, how much would we pay to get a guaranteed 3,500? Well, we need to get, if the risk-free rate is 2.5%, and this is totally risk-free, if we get this much in 1 year, that's equivalent to this much today. That's okay. Now, if we play this rolling of the dice in 1 year, and some fancy finance professor might tell me I've got everything wrong, I'm really struggling, I don't see what's wrong with this, I need 10% more, just like I did today. This was today, and in 1 year, I need 10% more. Okay, that's got 10% more. It's the risk premium is 358. I need 358 because I need to get my regular money back, and then if I was going to get paid an extra 350 here, I need this much in 1 year. And then we could play the same game in 10 years. And in 10 years, if I take 2.5% raised to the 10th power, okay, that's 1.1 plus 2.5% to the raised to the 10th power. That's this, and I take this multiplied by this, I get this amount. This is the risk-free equivalent, or whatever you want to call it, the future value. Okay? If it's risky, I need to add 10% to that again. And then my risk premium, when I multiply it by 1.28%, goes up, or this risk-free premium is again 10%. I cannot understand, or I cannot come up with a justification, and I think I'm right about this, to say the risk premium goes up or compounds by itself or goes up more because we need our 10% extra, whether it's in 1 year or 10 years or today. I can't understand what's wrong with this little example. And now let's get interesting. Now let's look at what happens to the IRR. Oh, I made this too small. So now perhaps I'll either expand it. Yeah, how about that? That's a better way to do it. And in our 1 year case, uh, if we have a risky cash flow, I hope I didn't screw up here, and we get this amount in 1 year, okay, then our IRR, we said, okay, we're going to pay this amount, this base amount, and we need a 10% premium, plus we need to get the risk-free rate. We need to get the time value of money at the risk-free rate plus our 10%. So this is the value today, this is the risky value in the future. The IRR on this is 12.75, which sounds like it's a high one, but it's basically the 10% risk premium that would give you, remember the risk-free rate was 1.2%, so 2.5%, excuse me, 2.5%. So if I take 12.5 minus 2.5, I get a little more than 10%. It's pretty close. Okay. If you, now I'm going to show you this risk premium method, and I'm worried about it. I'm wondering if you're turning off the video already to not believe that there is a really better way to do the IRR. And this risk premium method, I say, well, let's just take at the risk-free rate, let's measure the present value at the risk-free rate, and let's measure the present value of this at the risk-free rate, and then we'll divide it by the initial value, and we get our 10% back. And this is pure, we get a 10% premium back. And you say, okay, shut up. It's got no real implications for me. And then I'm going to say it's got dramatic implications, because if we play the same game and we say, okay, I'm just getting my 10% risk premium back in 10 years instead of in 1 year, and I take my IRR and play the same kind of thing, I get only an IRR of 3.48% versus 12.5. Oh my gosh, what's wrong with this? Did I make an error? I thought, okay, I could have made an error. And then I can say, okay, well, let's go up to our table, and if we would take the if we would take the excuse me, if we would take the present value at the risk-free rate and compare that present value, the present value of this thing at the risk-free rate, this number becomes this, which is our 10% premium. And if we would say, oh no, I just want a 10% risk premium, this is the IRR you're going to get versus this IRR. The IRR is totally different. Just look at just bear with me, okay? And if we just put our risk-free rate, we get an IRR of 2.5%. So we can't play this game where we take the IRR minus the 2.5 and get a 10% anymore. And so what I am trying to do, I hope, in the writing of the book, I hope I'm really explaining it a lot better. Now let's go a little more. So now I've tried to make a couple of more simple examples, and then I'm going to show you a example where we have 60 years or 30 years, and we have different growth rates in cash flow. And I'm going to show you, depending on the age, the length of the project, the age of the project, and depending on the pattern of cash flow, whether it's flat, grows, goes up, or comes down. I suppose I should put this a little smaller now. I'm going to also, when you try to make a graph that just kind of steps up and steps down, that's not an easy thing to do in Excel. And I'm going to make another, I've put a page in my website that kind of explains how to do that. And I'm going to make a short note really on how to do that, because I hate those ones where they kind of diagonally go up, okay. And in this case, with a 30-year case, for example, our risk premium that we're actually earning, we're going kind of the other way, we're figuring out how much we actually earn, is 2.9%. If we take a flat case, it's, oh shoot, I've got a phone call. Okay, I'm back from my phone call. Now, I didn't explain something well enough, but now I get a chance to do it. Every single one of these has an upfront investment that we've got cash flow that goes up, cash flow that grows, cash flows that's flat, cash flow that goes down. Every single one of these was designed, and I used a goal seek, but basically a multiple goal seek, so you can use a solver to do a multiple goal seek, and I'll show you that in just a minute. But here is what is interesting for me, so dramatic, is that even though the IRRs are all the same, the risk premiums you actually earn, that 10% risk premium that I showed you that you actually earn, is different depending on the pattern of cash flows. And that all comes about because of our IRR reinvestment rate headache. And basically, we're throwing out the reinvestment rate and we're saying we're going to compute the base value at the risk-free rate and then put the risk premium on top of that. I've got to show you the mechanics of that. I haven't quite done that. But we get, if the cash flow, so if you've got an equity cash flow that kind of starts low and then goes up after the debt is paid off, for example, the risk premium you earn, even though the IRR is the same, is a lot higher on that cash flow than some kind of cash flow where you would get a decline. You get all your money up front and then a decline. Again, it's all associated with the IRR and the reinvestment and all that. And in that case, the risk premium is 2%. So this is almost 4.5% versus 2%. That's a big difference. That's in a 30-year case. And then we, I didn't put the graph of the 60-year case. Okay, I'll go to the Excel to do that. But then I'm showing you, okay, if we do a 30-year case, here's kind of our risk premium, and I try different patterns. It's basically the numbers in the graph. If we do a 60-year case, then we're earning a higher risk premium in each case. In some cases, we're earning, even though the IRR is always 7%, again, the IRR is always the same, we're earning 43% more when we measure things with a risk premium, a 60-year case versus a 30-year case, even though that's because this IRR in these long-run investments, it just flattens out. And the risk premium doesn't, because of the measurement of using the risk-free and objective kind of rate that's not anything. Well, you couldn't debate that a little bit, but you're using a rate that's not, because you don't want inflation risk, okay? Fine, in long-term bonds. But you're using you're getting a much higher risk premium for the long-term investment, even though the IRRs are always the same. Okay, so I think if we can prove to you, okay, measuring this risk premium, just like an equity market risk premium, just like an earned credit spread, measuring a risk premium, it can be done. It's not mechanically all that difficult. Okay, we can't put RP like IRR into Excel, although you could easily make a user defined function to do that. Uh, um, uh, uh, it has important implications, and I believe it's actually theoretically correct. So I'm going to return, I'm going to skip to the backup Excel sheet. So what I'm going to do is, whoops, I've got some stuff here. Okay, I got upset about this. In this page, okay, I don't have it yet. I have almost nothing in this page yet. I'm gonna put the backup files. You can see they're not there yet. Okay, I've put much more in the courses for the tax equity, for example. I'm trying to make these put the videos together with all of the other stuff. Okay, so that's where this Excel file is going to be. Now I've got it kind of mixed up. I've got to go through these charts like I told you, because if you don't use these charts, you get these diagonal things that I hate. Isn't it much better to have a chart like this than that? Okay, but before we do that, let's go through a simple example. And I suppose, gosh, I'm gonna even do this now. I'm gonna go to my generic macros file. I don't know what to title this video. I'm going to say there really is something better than the IRR, and that's computing the actual risk premium. Okay, so let's kind of show you how this works. Okay, I suppose I put this in column B. It's finding the sum column, and I so ridiculous. That was kind of stupid to do this. Let's not put a title. Let's use this. We don't need a sum column. That's what was taking so long. Okay. And so I just want to show you what the inputs are and what the outputs are. Okay. And I've got a little 1 period, 2 period, or 3 period case. Okay. And okay, and so here's some input. So let's put a 1 period case. And in a 1 period case, what I did here is I put a risk-free rate here. And this 1 period rate says look up. If it's 1 period, look up and pick this one. If it's 2 period, do this. And then we've got a little true false flag to work through that. And I said, okay, well, in this case, in the 1 period case, this is easy. We have a growth rate and we don't have any intermediate problems, so we don't have any reinvestment headaches. So if I take this divided by that, I get 10%, which is the IRR. And if I just do something simple and I just say, okay, well, let's just take the IRR minus the risk-free rate, I get a risk premium of 7%. Now, here's the mechanics. Step one is to say, let's take the net present value at the risk-free rate of these cash flows. That net present value is not controversial. You don't have any BS. You don't have any cost of capital, the risk premium estimates. That's the output. And then you just take this. I've gone around and around and around with this, and I've tried it a whole bunch of different ways. And then you take that, and that's that's kind of your 7% risk premium. And then, well, I don't know I put the aggregate risk premium earned as just the different one minus this, right? And then I levelize this. It's a concept from project finance or whatever, electricity, and you just take a PMT. You take this payment, and this time you take it over 1 year, and you get your 7%. Okay, and then I said, okay, well, let's do a little bit of a proof, and that says, well, okay, if I was just earning my 3%, and this is my actual earnings, then I would earn a 70 above that, and that divided by initial investment is my risk premium. Okay, that's the mechanics. So I tried to put step 1 and step 2 and step 3. Now let's change it to 2-period case. Okay, in the 2-period case, we're having a lower rate of return because I'm taking this 1,100 and dividing it over 2 periods. And when I do that, the IRR is less. If I just do this kind of raw subtraction, that really doesn't work anymore because it's got, I need to prove it a little more, but it's got implicit kind of headache, rate of return headaches. So instead, I go through the mechanics. Number 1, take the NPV. Number 2, divide it by the initial investment. And you could, I guess, if you have a multiple different cash flows at the beginning, then you're going to have to push them forward or bring them back. Okay, we have to make an adjustments for all of that. All right, and then that's our kind of, this is our aggregate risk premium that we earn over the whole period. But then we take a PMT of this number and split it over 2 periods, but we use the risk-free rate in discounting. Don't use anything else. And then you get that you've earned this time a 2.74% risk premium. So that this IRR gives you a 2.74 risk premium. And what we can do is say, okay, let's pretend we have a risk-free rate, and that means we get a level payment for 2 periods this time. And if we compare that with our earnings, that's our earnings, and we divide that by the initial amount, and we've proved that that's really works, that this little 3-step process really works. And let's take a third case, a 3-period case. And in a 3-period case, sorry, the cash flow is just split divided by 3. So we get a lower IRR. When we get a lower IRR, we can say, well, that could be kind of like a 1.92% risk premium, but it's not. We first compute, once again, I'm redoing this NPV, divide it by the initial investment, take that number and compute the PMT on that number, and you get 1.31 instead of your kind of crude method. And then you can put the level payment. This is the level payment if we have an initial investment and we're getting the risk-free return. This is the amount we earn above the risk-free rate, and that's our risk premium that's constant. Now, if things change, don't worry. It all works with much more complicated examples. But what I'm going to do right now is I've gone 34 minutes and I'm trying to keep these videos a little bit shorter, so I'm going to stop this, and this is going to be part 1, which goes through the theory and some simple examples of our